Good day, and welcome to the SNN Network Summer Virtual Event. Our next presenting company is XS Financial. It is now my pleasure to turn the floor over to David Kivitz, CEO of XS Financial. Sir, the floor is yours.
Thank you for having us, and appreciate everybody coming to listen to the presentation today. David Kivitz, CEO of XS Financial. XS Financial is providing CapEx and equipment financing for best-in-class U.S. cannabis operators, and look forward to giving everyone an update on the business and an overview of what we do. So this provides an overview and summary of our company currently. As shown on the right, ours is a specialty finance business growing a leasing portfolio. To date, we have deployed just shy of $34 million. We have committed to fund just north of $62 million. So we have very good visibility into where our next funding will go, absent adding new customers, which we intend to do as well. We keep a reasonable 68% portfolio lease to value, which is our exposure against our equipment collateral. Our average lease across the portfolio is just shy of 4 years, and we currently have just over $925,000 a month of monthly recurring payments that our business will receive for the next 46 months in a row. And so what you have here is a stable base of cash flow, all secured by equipment as well as guarantees from some of the biggest and largest cannabis companies in the entire United States. We are diversified across the country, so if any one in particular state level market were to have credit issues or a broader issue, we have good diversification and feel that we are very well positioned as the leader and as well future leader, albeit a much larger business, really as the sole platform focused exclusively on CapEx and equipment finance, which for those who are not aware, as cannabis companies in the U.S. are required to set up infrastructure on a state-by-state basis because it is federally illegal and because they can't cross product across state lines. There is a significant amount of infrastructure that is required, from packaging lines, bottling lines, vehicles, food processing equipment, testing equipment, cultivation equipment, including lighting, racking, benches, as well as a host of other things. And we are really centrally positioned to finance all of it. Our core model is really to sit in the intersection of the equipment vendors, of which we now have over 150 different equipment vendor partners through our preferred vendor program, and then also with the customers. And so our model is to earn interest income from our customers, and then we also purchase the equipment from our vendor partners at discounts that range in size. And so, because of that, we always have the ability to be competitive with the customer because a portion of our return is actually coming from the equipment vendor, and we think that that's a very powerful model. As shown here, we've been very busy. We closed a $10.5 million equity financing in March. Our capital deployment is almost up 750% year over year. Our growth in monthly recurring payments is up 500%. And last year, we also entered into a strategic partnership with Kushco, which is the largest ancillary supplier of packaging to our industry. And through that, they also acquired a stake in the business. As much as we are excited about the growth, we are also excited about the quality. And as shown here, Columbia Care, Air Wellness, PharmaCann, the confidential company that we have yet to release the name of, those represent 4 of the 10 or 12 largest cannabis companies in the country. And, we think about not only the returns that we're generating on our leasing portfolio, but also our risk-adjusted returns. And we think that we have selected a group of high-caliber companies. We don't work with startups. We're really looking for established businesses with significant financing needs. And as shown here, at least across those 4 companies, we have committed, to invest almost $50 million, of which we have funded a significant portion, and yet still have, as mentioned, about another $30 million to fund to a handful of companies who are listed here, not including anything that is in our pipeline. And so, we're very happy with our customer base. We focus as much as we can on providing them a service and a quality in terms of experience that makes them want to continue coming back. And in many cases, these companies have used the lease facilities that we give them numerous times. And so we have seen, with some of our companies, we are literally on our 25th or 26th lease, and continue improving the speed, removing friction, and assisting their businesses grow as best we can. This really lays out what I think we've done well over the past year or so. And, what is most worth noting, in Q2, we essentially doubled the size of our portfolio from what we had done the prior year. So in 3 months, we had deployed as much capital, increased our recurring payments and our receivables as much as we had over the prior 12 months. And thus far, we are only 6 weeks into Q3, and we have essentially doubled again. And, what that should provide comfort to investors is that we are moving faster. We have an existing customer base now who likes the product that we are providing to them. And as a result, they are coming back to us faster. Their demands are greater. And we continue funding in to their needs while also, focusing on a pipeline. What I'll also highlight in the bottom right quadrant is it shows active lease schedules. And in Q2, we closed what was at the time the largest number of lease schedules for a quarter. We believe that Q3, we will exceed the number that we completed in Q2. And what this is starting to show is not a linear growth path across the portfolio, but an exponential one. And so, with the demands that our customers have, our ability to continue financing our business and funding our customers, we think we are well positioned, as mentioned, to really be the largest, the market leader, and the furthest out ahead by far to handle all of the equipment financing needs for, any reputable and creditworthy company in our industry. This provides some visibility and some data and metrics surrounding the portfolio itself. On the top left, where we show our concentration by customer, it's to be expected that at our current size and with only 9 companies, that we will have some concentration. That is not something that concerns us today. That's going to naturally smooth out over time as we add new customers, as we continue funding some of the ones who, have yet to draw on their full facilities that we've committed to them. So that will naturally balance over time. We have selectively syndicated or offered investors participation in some of our larger companies' lease transactions that we've closed. And so we've reduced our risk exposure in some cases to those customers, which we think is a prudent move. As mentioned, we're very well diversified across the country, across state by state basis. So we think that that's positioning us nicely in case, a state has a particular issue or a supply-demand imbalance. So far, that has not been an issue, neither in our portfolio where we have no defaults and no missed payments, nor in the states that we are currently providing financing. Net equipment value by type really just shows the type of equipment that we're financing. And then what I think is a very interesting stat, and most lenders look at this with particular interest, is, almost 85% of the equipment that we finance has little to do with cannabis at all, other than the companies that we finance are using it to produce their products. And so why does that matter to us? Well, a lot of the equipment vendors who produce that equipment produce it for packaging. They produce it for food processing or vehicles or testing equipment, warehousing equipment like scissor lifts or forklifts. These are items that have robust secondary markets. The market that if there was a credit issue, if we had to repossess equipment, that we could sell that equipment into is not just cannabis companies. And obviously there is significant demand from cannabis companies for this equipment. So certainly we feel good about that market if we had to access it. And of course, having existing customers who may need some of this equipment if ever there was an issue is the immediate first place that we would go and consider offering it. However, the universe of companies and types of businesses that would be looking for the equipment that we may repossess in a default scenario, is fairly broad. And accordingly, the equipment is not highly specialized. We feel very good about that. And in fact, spend quite a bit of time with our vendor partners, vetting them and making sure that they are, have adequate service departments, warranty departments, manufacturing capability, because at the end of the day, this does serve as our collateral. And we want to make sure that the companies that are producing it are similar to our customers of quality and scale. Here, just a quick snapshot of some of what we've accomplished over the past 3 months. We've been very busy. We've added 2 new companies to our portfolio. We have funded a significant amount of leases, as mentioned. One particular interesting note is highlighted on the top right of the screen. Despite the capital challenges in our industry, because we are not a cannabis company, we are a finance company, we actually have a senior line from a bank. And so one of the benefits of being an equity investor in our company is getting leverage from a bank at a reasonable cost of capital ahead of our customers. And so we think our financing and the ability to finance our business is going to stay very robust, particularly as we scale, prove out the model. And we think that that is all going to be very supportive of our ability to access additional credit. It's something that we're very focused on, and increasing our lending lines so that we can go out and put significantly more capital in the hands of our existing customers, as well as new customers that we will bring on the platform. Now, here's a good snapshot of some of those vendors and vendor partners that I mentioned. These companies make a varying and wide and robust group of products, from lab equipment to everything else that I had previously identified. And we feel very good about the companies that we're partnered with. This list expands weekly. We also do not require that a company or an equipment vendor be on our preferred vendor program to work with them. So in many cases, it's our customers bringing us vendors and us adding them to our platform as a result of the type of equipment our customers are looking for. And we think that that has been a good process and has helped us continue to expand the network of vendors that we work with. Talk a little bit about the product. I think what we have become really known for is what we call our lease facility. We work with companies to identify how much financing they think they're going to need over a period of time, and providing there's no material changes to their business during that time, they can use it flexibly as they like. We set the terms up front. We sign a master lease contract, and thereafter they can use it on a piece of equipment by piece of equipment basis, and we keep adding subschedules to the back of the master lease, or they can do it all up front and all at once for all of the equipment that they require. The benefit, of course, is that they can use it flexibly. It works within the context of the needs and the flow of their business, and we think that that has been really crafted for the benefit of the customer. And it shows by virtue of the fact that, we work with some of the more significant sized businesses in our industry who also have other financing options. Yet they have chosen to work with us. They keep coming back to us. We've upsized our commitments to our customers now a few times and expect to continue doing so. So, we will continue to offer the lease and the sale leaseback as well. But really and primarily, most of our customers are under the lease facility currently. I mentioned earlier, companies in our space have to set up infrastructure on a state-by-state basis. We don't think that that's going to change anytime soon, whether the industry is federally legal or not, although we think it's quite a ways away for that to happen. This is really just outlining, this is not a small segment of our business. This is a huge financing need. We've barely scratched the surface, and yet we are the market leader. We expect to really lean into this, own a big chunk of this market, and really feel like we are just hitting our stride and getting started toward that process. We have a very strong team. Our team is comprised of folks who have had institutional backing, have grown companies as entrepreneurs, have run the credit side and the sales side of extremely established equipment finance businesses. And so when you bring all of that together, you have a very capable team. The benefit of a business like ours is you do not need to expand the team nearly at the pace that you expand leasing activity. You get a lot of operating leverage in our business as a finance company. So we think we have all the key people sitting in the right seats and operating the right roles right now. And we do not expect to be adding a number of people in the near term, even though we expect to add quite a bit of new leases. So we're very excited about that and very pleased with the team that we have brought together here at this stage of the business. As shown, the market cap of our business at a $27 million Canadian valuation is less than the size of our portfolio. We think that we need to do more IR, more market awareness, getting in front of more investors, really to make people aware of the work that we're doing and the pace at which we're growing, and intend to lean into that quite a bit here in the coming months and the coming years. And that is XS Financial, and would like to open it up to questions. And I see we have a few here. The first is, how does future rescheduling of marijuana potentially affect XS in the future? It's a question we get a lot. It's a good question. It's going to be impacted in good ways and bad ways. Equipment finance is a lucrative industry that exists in basically or alongside almost every major industry in the world, especially those with heavy infrastructure. And so for that reason, we have every kind of reason to believe at this stage that there will be a place for our business, whether the industry is federally legal or not. What may happen, for example, if the state-by-state nature of the industry changes, is things will move to regional production facilities, regional cultivation facilities, and all of a sudden the infrastructure needs will become more expensive, different, varied, and in some cases similar. And so the ability to service the customer base, really provide for them what they need is something that we think an awful lot about and really want to focus on and continue to focus on. And of course, as mentioned, we already have bank financing. We think that we will become a very natural place as a conduit for other lenders, even other equipment finance companies to stream our deals. And so, given that we already have built out 200 equipment vendors on our platform, plus a significant number of the major companies in our space, we think that we have an opportunity to reduce our borrowing cost, which we can also pass on to our customer without actually reducing our net interest margin, which is really the name of the game for us. So we're excited about kind of the regulatory shifts as they come, although we'll caveat that by saying we don't expect them to come quickly. Next question is to talk about the regulation side of the cannabis industry and how legalization or safe banking can impact your targeted ROIs. We kind of just touched on that in the first question, and so I'm going to kind of move on to the next one. From a collateral perspective, what is the process regarding resale and how liquid is the market more generally, understanding, of course, it's not all cannabis related. We work with and require, for example, on a sale leaseback, of which we've only completed one, but we've underwritten 4 or 5. We require third-party valuation and appraisals on any equipment that was not ordered during the time of either underwriting, term sheet, or post-closing of a deal. And most of the firms that we work with on that side all have resale businesses, auction businesses, things like that. We do get data from them at an aggregate level to understand how robust is that market. Today, the equipment vendors that we work with and most of the equipment that we order for our customers or finance for our customers have significant lead times. That might be 2 months, that might be as long as 7 months. And because of those lead times, there is significant demand for the equipment. And if you have something in stock, that puts you in a position where, the values are somewhat supported. And so if you're not financing customized equipment, customized for one specific purpose, if it's brand name and the equipment vendor that's behind it is of quality, and you have the ability to redeploy it right now into a market that's exceptionally demand focused, then you should see values very well supported. The other thing that we do to protect equipment values is we enter into resale programs and refurbishment programs with the equipment vendors themselves. And in fact, the largest lighting company in our entire sector is somebody that we are entering into one now, and they want to make sure that they have certain controls over the secondary market of their equipment. They are speaking to all the customers about it, so there is no better source for remarketing, resale, redeployment of that equipment than working with the equipment vendor partners who are already obviously dealing on the sales side of putting that equipment back into production, or having customers who are seeking that specific equipment. So that is something that we think a lot about. Fortunately, we haven't had any issues with the portfolio to date. But we think that the market is reasonably robust, and so we're happy with the collateral that we're financing for that reason. Final question I have is, based on the current economics of the leases you are writing and your current access to capital, how are you thinking about longer-term returns on equity for the business, and what would that imply from a company multiple perspective when compared to other equipment finance businesses? Very good question. So to date, the portfolio is yielding right around a 17% yield on an unleveraged basis. Our goal as we scale the platform and add leverage is to see those returns kind of hover in the high 20s on a leverage basis, assuming a rational and reasonable amount of leverage. And typically companies in the specialty finance space and especially equipment finance businesses tend to trade as a multiple of book. We expect to see the book value of our business increase dramatically over the coming years. And, given that we will have these cash flow streams in place for, longer term durations, we feel very good about the fact that we should trade at a premium to kind of down the fairway or standard equipment finance businesses, just given the pace that we feel we can grow, the returns that we're generating on our leases, the quality of the collateral, but mainly, and in addition, the credit quality of the borrowers that we are financing and our ability to continue putting dollars out to them. And so, we think that, if you look at some of the other specialty finance companies, not who are financing equipment, but financing real estate and who may have similar customer concentration to us in our industry, they are in some cases trading at multiples of book value that are well in excess of the standard market. And so given that we're small right now, we do not have that multiple attached to us yet. We think that's a good reason for, investors to take serious consideration in the business, given that we are growing at the pace that we are and have now closed, 45 leases with a very similar return profile across the entire spectrum. So we're very happy with kind of where we sit today. We think that we will get a healthy multiple, not only from scale, but also, over time, hopefully transitioning to a major exchange and continuing to evolve the business. We have 3 minutes left. I figured I would put it out there one more time if anybody would like to ask any final questions. With that, appreciate everybody's time and attention today and coming to learn more about XS Financial. If anybody would like to follow up after the presentation, my email is dkiv as in Victor, ITZ @xsfinancial.com, and look forward to hopefully hearing from some investors. And thanks again, everybody, for the time, and thank you to SNN for hosting.
Ladies and gentlemen, that does conclude the XS Financial presentation. Thank you for joining us. You may now disconnect.